Welcome back to AM Northwest. Interest rates have been at historical lows for more than a decade, but they're starting to rise. So what does that mean for our retirement savings? Here to tell us, we welcome back financial planning and consulting specialist David Swanson. Always good to see you. And you brought Butch back with you. Yeah. We've missed Butch for a while, so it's good to see him again. That's awesome. There is Butch. They're taking a little nap. So let's talk about the interest rates. They've been steady, low and steady for quite some time, but you see changes.
About a dozen years we've benefited from declining interest rates, and the old adage that, what goes down must go up is in play. And once interest rates start to move, that's when some changes can really occur in the marketplace. And if interest rates move at a slow level, gradually move up, things can be absorbed and we don't see big swings in markets typically. We've enjoyed over the last couple of years a phenomenal economic cycle. Stock market indexes have gone to levels that we really haven't seen. We're setting new levels all the time now. I read unemployment is down at levels that they were at 5 decades ago. So people, and you've seen signs everywhere, we need work, workers come work for us. So I'd never seen anything like that in recent history around our local area. So things are really good, and with prosperity come higher interest rates, and everyone gets more wages, costs of everything goes up, and eventually interest rates will start to rise. If you own investments that are in bond funds or in longer term bonds, you will suffer losses if there's a sharp rise in interest rates, and you need to be aware of that. And what happens is that a lot of inexperienced investment advisors will rush clients into bond mutual funds. And if rates do move very quickly in a short period of time, you will see substantial declines in those values of those accounts, because it's very simple that when interest rates go up, bond prices decline. And for 10 years, it's been the other way. As rates have declined, we've seen all fixed income prices increase in value. So there's a real hidden pitfall in there that if you think you're rushing to the safety of bonds, you actually may be putting yourself at peril at the time when you can least afford it, retirement.
Wow. And then how high do you expect? I mean, I think I recall in the 70s that interest rates got up as high as 20%.
My first mortgage was 14. Would you pay 14% for
No.
mortgage? But that was what the rate was.
That's what it was, yeah.
CDs in the mid 90s were in the double digits. We saw in the 80s CDs at even 18% for 1 year, and people were only buying 1 year CDs because guess what? They thought the next year rates were going to be higher. Would you like to have an 18% CD right now?
Wow.
That would be fantastic. So rates have been all over the place. Are they ever going to go that high again? I don't know. Are they going to go lower? We don't know that either. But we do know for sure that if rates move very quickly in an upward manner, there will be effects on the stock market that will not be to the advantage of most people.
So if you're looking at retirement, what should you do?
Well, you got to be very, very careful about the advice that you get. And if you're in a position that you don't really understand what you own, or someone is making a recommendation for you to change part of your portfolio into bond funds or any fixed income investments that have long-term maturities, you need to really be very careful about that. And this is a great opportunity to get a second opinion on your portfolio, because things are going to change. The markets, as they've been, are going to be different going forward.
Okay. So I tell you what, we have a lot of questions that our viewers sent in to ask you. So we're going to take a break, and when we come back, David's going to answer your retirement planning questions. Stick around. Thanks for watching AM Northwest. David Swanson from Swanson Financial is back to answer your retirement planning questions. Today we're talking about how increased interest rates could impact our retirement savings. So here's a question. Our stockbroker has recommended selling half our stocks and buying Class A shares of a bond mutual fund. What risks and costs might we be facing by making these transactions?
So those are the two most important things to look at: risk and cost. All right. So an A share fund is a type of a commission where you pay all the fee up front. All right. There are many different pricing models for mutual funds. Make sure you select the one that works for you. But an A share is you pay all the fee on day one. The risk associated with a bond fund, in my opinion, is pretty high if you think interest rates are going to go higher. 10-year Treasury last year was around 2.3%. Today, around 3.2, so almost a full 1 percentage increase in just 1 year. That is a very large move in interest rates.
You know, in our last segment, I misunderstood but when a CD has a high interest rate, that's good for us.
We want the income.
Right.
The bank wants to pay as low as they can, but they have to pay a competitive rate to attract dollars. And the interest rate market is set by the environment, about inflation, about job growth, about all kinds of things. And we have enjoyed, again, a very, very low interest rate environment, which has benefited all of us tremendously. And if this event occurs and interest rates do start to move up very quickly, we have to be careful and plan for that.
And speaking of which, this question is, in the mid-70s until about the mid-90s, we saw interest rates range from 8% to 20%. Could interest rates go back to these levels in my lifetime?
Who knows?
Yeah.
You figure about every 10 years we see a market cycle. We're 12 years since we've had the really last market cycle. We'll see. We'll see what happens.
We own a large amount of bond mutual funds and have for years. In the past, they lost value and our account balances have declined. Can you explain to us what is going on here, and are we in trouble with our retirement savings?
So this is what you got to be careful about bond mutual funds. So you own these bond funds and you've owned them for years and they've gone up in value because interest rates have declined. Well, the exact opposite is happening. It's a teeter-totter. When interest rates rise, bond fund prices go down. So you've seen income from your accounts, but you've also seen a decline in the principal, and you've got to make sure that that fits in with what your what you think the future of the market's going to hold. It's a great opportunity to get a second opinion from a fiduciary advisor on your account.
We are almost retired and we want to make good and safe decisions with our retirement savings. We meet with an investment salesperson. We met with an investment salesperson last week, and they recommended a mix of bond mutual funds offered by their bank. Can we meet with you to discuss these options?
And this would be a perfect time for you to sit down and give us a phone call and say, hey, this is what we've seen. Can you give us some idea how would this fit into what would be our best? Because the best interest, because we, as being a fiduciary advisor, we must put the client's best interest before you, as most other salespeople don't have to. 9 out of 10 advisors are not fiduciary advisors. Right. So give us a call or go to one of our workshops and gather some knowledge. Make sure that you understand everything that you're doing, because this is your life savings, and you really have one shot at getting this right. If you make a mistake when you retire, you may have to go back to work.
Oh, that would be the worst. I went to the bank and the salesman showed me a brochure with an American flag on the cover. Does this mean it is safe and protected by the government? This is a good question.
And this is what happens.
Because that's the impression you're trying to give.
Well, you think, and of course all mutual funds are not FDIC insured, just because it's issued by a bank, and there's many disclaimers on that, and people need to understand that. And just because there's a flag on it or a U.S. government building or something, it doesn't mean that it's guaranteed and backed up by the government. You need to understand what the security investments are involved in. But if you own a bond fund that has longer term maturity, 7+ years, and interest rates move sharply up, your principal will decline dramatically, and you just need to be prepared for that.
Okay, and we want to tell folks, if you'd like to find out more, contact Swanson Financial, 503-603-9900. We'll put it on our website at katu.com. David, thank you.
You're welcome.
And Butch, thank you. Which is down there taking a nap.